I've spent the last 15 years building life insurance policies for thousands of families, large businesses, and even a billion-dollar company. And here's everything you need to know about life insurance. Life insurance is a contract, and this contract is only as good as you make it. The agreement is straightforward. You pay a premium, and if you die while that contract is active, the insurance company will pay out what is called the death benefit. There are several parties with a life insurance policy. First, you have what is called the insured. The life insurance is on that person, meaning the death benefit claim is paid when the insured dies. You have the policy owner. This person or entity controls the policy. They name the beneficiaries and they have access to the cash value. They're also the one who is usually paying the premium. A policy owner can be a person, business, or trust. And then you have the beneficiary. The beneficiary gets the life insurance when the insured dies. A beneficiary can be a person, business, or trust, just like the owner, but with the beneficiary, you can also have more than one. Now, with a life insurance policy, you have a few pieces that are always included, but you can also add what are called riders. Riders are add-ons that give you additional benefit. One example of a rider is what's called a long-term care rider. You pay an extra premium for this, but in return, you get long-term care insurance, which means if you have to go into a nursing home or need home health care, the policy can help pay for those costs. Another example of a rider is what's called a paid-up additions, or PUA rider. What it does is accelerate the cash value growth of a policy, and it also buys you some more life insurance as well. Now, when you look at life insurance, a lot of people are interested in the product because of the cash value. We have a ton of clients that always say, I don't care about the death benefit. They say that because with a whole life insurance policy, you have cash value, and that cash value provides the following benefits. One, the money is not invested in the stock market. It grows safely and goes nowhere but up, regardless of how the market or economy is performing. You have a guaranteed cash value interest rate that will range between 2 and 4.5%. But if the insurance company that you have a policy with is profitable, you'll get the dividend interest rate instead. Dividend rates are declared one time per year, and if you look at the top mutual companies for 2026, rates range between 5.75 and 6.4%. There are two main reasons why people get life insurance, and they operate on completely different logic. The first reason people get life insurance. Let's say you earn $100,000 per year, your spouse does not work, and you have kids. If you die, what happens to your income? It stops. What about the mortgage? That doesn't stop. College tuition for the kids, everyday expenses, and everything else in life that costs money. None of those stop. If you die, would your family have a financial problem? If so, the simple way to solve that problem is with a term life insurance policy. Depending on your age, you could get a term policy for $1 million that lasts for 20 years, and it might only cost you $1,000 per year. And how it works is if you die during that 20-year period, your family gets $1 million, and that's paid out income tax-free. 99% of the clients I work with get life insurance for the cash value, not the death benefit. There are two main categories I put my clients in. The first is what I call a buy and hold client. These are people who usually have a lot of money sitting in the bank, maybe it's in treasuries, or accounts that are safe or relatively liquid. Then they learn how the cash value in a life insurance policy works, and they usually say, why doesn't everyone do this? So here's an example for someone who is 55 and they're looking to put $1 million into a policy. This is money that's currently sitting in fixed assets, safe accounts. So you've got a total of $1 million going into a policy over 4 years, and he has more than $1 million in cash value. He has a very healthy death benefit, so we can lower the death benefit after 7 years, which lowers the costs. And because we followed IRS rules, that yield is not only very attractive for a safe place to put money, but we can also access it tax-free. The second type is what I call the active investor. This is someone who is constantly using their money, like a business owner or a real estate investor. But when they learn about cash value life insurance, what they see is that their money will grow somewhere between 4 to 5%, usually a bit faster than what they're getting in cash at a bank, but they can also use the policy like their own bank. So let's pretend that you're an active investor. You've built the cash value up to $100,000, and we'll assume that the net growth rate is 5% per year. You see an opportunity that requires $70,000 of capital. So to get that $70,000, you take a loan against your policy. The most you can borrow is whatever you have in cash value. We'll assume that the cost to borrow is 5%. The growth is $5,000, because when you borrow against a life insurance policy, you continue to earn that 5% on the full $100,000. You do have a cost, which is loan interest, that goes to the insurance company at 5%. That would be $3,500. You have a positive spread of $1,500. So we take that policy loan of $70,000 and we invest it into an opportunity. Let's assume it's a real estate deal. And we'll pretend that the return we can earn on this property is 10%, which would yield us $7,000. Now, there are 3 different types of life insurance, and understanding all 3 is crucial if you want to make the right decision. Let's start with the simplest form of life insurance, term life insurance. So with a term policy, the first thing that you'll see is a term, which is the number of years that the life insurance policy is active. It's most common to see a 10, 20, or 30-year policy. Now, term insurance does not build any cash value. However, it does serve a need, which is providing life insurance at a very low out-of-pocket. The next type is universal life insurance. And the most common type is what is called indexed universal life insurance, also referred to as IUL. The premium can be level forever. I have the option to add more money to the policy if I'd like, and even fund it for a short period of time. Now, there's typically 2 death benefit options with indexed universal life. The first option is what is called level, and the second option is an increasing death benefit, which starts lower but gradually increases over time. It will project to grow beautifully over time. Key word I mentioned there is project. So what's driving that cash value is that your money is linked to an index. The most common index is the S&P 500 index. If the stock market goes up, you go up with it. And if the market goes down, your principal is protected, meaning you will flatline, but you will not lose money. This limits how much your money can grow by each year. If your cap is 10% and the S&P grows by 30% one year, your money will not grow by 30%. Instead, you'll see it grow by 10%. However, there are some risks with IULs. The first one is COI, which stands for cost of insurance. Often starts out very low, is as the years pass, the cost gets larger and larger. Also, something I don't like that I have observed quite a bit over the years is that the cap rate can be reduced, and in many cases, I see that it is reduced. What that means is that if you start a policy with a 10% cap rate, the illustration you look at assumes that that cap rate stays at 10% forever. But in reality, if 5, 10, or 15 years later, that cap rate is reduced to 6%, now the most you can earn is 6%. And a lot of times I've seen IUL policies underdeliver or even go backwards. I am not comfortable with them personally, but when I look at the guarantees, what I always see is that the costs exceed the guaranteed interest rate, meaning the guaranteed values always go down if my goal is cash value. The last type of life insurance is whole life insurance. This is the slow and steady wins the race product. First, I've got my premium, and this is guaranteed to remain level throughout the life of the policy. The death benefit will gradually increase over time, and the same is true of the cash value. If a dividend is not paid for whatever reason, you'll still have a guaranteed interest rate, and the big difference between whole life and universal life insurance is that with a whole life insurance product, you will see that the guaranteed cash value interest rate exceeds the cost of insurance. I am a big fan of whole life insurance, and the main reason why is because I've seen a better track record. When looking at real policies, not just illustrations, when you compare life insurance policies, you'll always see what's called an illustration. And the agent is usually going to point to the non-guaranteed values on that illustration. Now, the non-guaranteed values might show that you'll have $1 million when you retire, and you can use that money tax-free. The problem is that most life insurance policies underperform compared to what was shown on the illustration. The policy must be set up right for this to happen. Here's what I would do. If your goal is protection, start with term insurance. If your goal is cash value, I would do these three things. First, I would look at whole life insurance, specifically with one of the 4 major mutual companies, who are MassMutual, Guardian, New York Life, and Northwestern Mutual. I've seen proof that these companies actually deliver strong cash values to their policyholders, and they also pay lower commissions than most other life insurance companies. Number 2, I would look for 80 to 90% of whatever your payment is to your policy to show up in cash value in the first year immediately. If you see this, it means that the policy is maximized for cash value and minimized for commission. And then 3, look at the guaranteed values and make sure that they do not go down. Most people see an interest rate attached to a life insurance policy and think that they understand how the growth works. You have a guaranteed floor. Above that floor, you get the dividend rate. Instead, you do not get the dividend rate plus the guaranteed rate. So if you get a whole life insurance policy with Guardian for 2026, you'll see a dividend rate of 6.25%. The policy you get might have a guaranteed interest rate of 3%. Do you think you get the guaranteed rate, the dividend, or both? You get the dividend. The guaranteed rate is your floor, and if the company performs well, they pay a dividend, and the dividend rate is what you get. So this is someone who's putting $100,000 per year into a policy for 5 years. When we look at the guaranteed interest rate, it's 3% with this product. But as time passes, you do see these policies perform. The dividend rate is 6.25%. The annual yield is much stronger than what we saw when we looked at the guaranteed value. However, it peaks at about 4.75%. Now, if we look at a different product that has a lower guaranteed cash value interest rate, you'll notice that the guaranteed values look worse because I have a lower guaranteed rate. So this is meant to illustrate that insurance companies create some products that are more favorable in terms of cash value growth and other products that are more favorable in terms of death benefit growth. The most common objection I hear about life insurance is that it's a scam. And I don't think the objection is wrong. I think that it's just pointed at the wrong thing. I see consumers claim that life insurance is a scam. But when I talk to those individuals, it's usually because they were sold a bad policy. There's a lot of agents that sell life insurance that don't fully understand the product. And the big problem is that agents are incentivized to sell policies with low cash value. The truth is, if it was such a bad product, banks and corporations would not put billions of dollars into it. I would not question whether life insurance actually works. Instead, I would question the specific policy you're being offered. Ask, is this policy designed to benefit me, the agent? So this is a whole life insurance policy, same insurance company, the same insurance product, but just set up differently. So we've got an individual funding $20,000 per year. Policy A, $20K goes in, and what's your cash value? $1,700. What's highlighted in yellow is when they finally have more cash value than their total payments. It took him 13 years just to break even or get his money back. Policy B definitely looks better up front. He pays in $20K, and instead of having $1,700 in cash value, he has about $10,000 in cash value. It also breaks even sooner, but then look at policy C. He pays the exact same $20,000, and he has about 85% of his payment available in cash value immediately. He breaks even way earlier when we look at it as well. Here's what I mean when I say, is your policy meant to benefit you or the agent? At year 20, Which option gives you the most cash value? Option C. When you look at the agent commission, which one paid the most? Option A. That's the option with the least cash value from start to finish. When you look at option C, what do you see? The lowest commission. See what's going on here? This is why I say the industry is incentivized to sell policies that are not in the client's best interest. So, who should actually consider getting life insurance? Well, everything in this video leads to this question. Do I need life insurance or do I want life insurance? Do I need life insurance? Ask yourself this question. If I die tomorrow, will my family have to change their life? If the honest answer is yes, it's worth looking into life insurance. And to keep it simple, I'd start by just looking at term quotes. The next question is, do I want life insurance? Not because you want to die. No one wants that. But because you want the cash value. Or if you like the fact that it grows safely, it's tax-free, and you can borrow against it while the money keeps on compounding. But I would still ask yourself those two questions. Do I need life insurance? Or do I want life insurance? If you want to go deeper on why you should take action when you're in your 30s, there's a video on this channel that covers exactly that. You can watch it here.